$200 trillion. Is this the size of the US economy? No, that's around $32 trillion. Is this the size of the global stock market? No, that's somewhere around $154 trillion. These $200 trillion is the estimated size of a financial system most people never even heard of. A system that doesn't look like a bank, doesn't call itself a bank, isn't regulated like a bank, yet it moves your money, funds your loans, and shape the economy you live in. Today, we are pulling back curtains on something we called as shadow banking. So, tell me, would you trust a bank that isn't even a bank? When you hear the word bank, you imagine an institute which is regulated, of course, that accepts deposits, have regulators, have central banks protection, and of course, safety nets. But what if I told you there is another financial system operating right beside it? See, when we're talking about traditional banking, regulated institutes, you accept deposit, have insurance on the deposits, central bank overseeing it, strict capital rules, publicly visible. But when we're talking about shadow banking, they are basically non-bank entities, no insurance on the deposits, have not a direct control or regulationary body, but they are driven by market forces, and most importantly they are mostly invisible to the public. Now, it's called shadow banking, but don't let the word shadow confuse you. It's not at all illegal, it's not even a secret, but it is affecting your life right now. See, most people think that banks usually exist so that they can store your money, the money that you bring to the bank as deposits. But that's not really their primary job. Banking exists so that they could figure out and make a medium of credit creation. The real businesses of bank is not to accept deposits but create credit. That's why often economists say that loans are the reason deposits exist and not the other way around. Right? They take deposits and transform them into loans, thereby multiplying money throughout the system. It works in a way that, let's say I went ahead and deposited 10,000 rupees in a bank. Let's call it bank A. What bank will do is they are regulated, so they would keep 200 rupees liquid, and 8,000 rupees would be given to a new borrower. What that borrower would do is spend, let's say, 8,000 rupees. Let's say he bought in machinery, right? Now those 8,000 rupees would be transferred to someone who sold that machinery. What that person would eventually do is take that 8,000 rupees and deposit it, let's say, in a different bank, bank B, and a new deposit is created. So from the single 10,000 rupees, a new deposit was created, a new loan was created. Right. This is how banks help create credits throughout the economy. One deposits enable multiple loans. And this process will again start to happen. 20% would be kept aside and 80% would be flowing again in the economy. So why shadow banking exists? Right. If bank already existed, why create another system? See, the biggest problem is banks are heavily regulated. They surely have capital requirements. They must hold large reserves, right? There are liquidity rules. They should maintain cash buffers like the 20% in the previous example that we talked about. It has a lot of compliance costs. They are heavily regulated, right? And they can't lend everything, right? So what the best part about financial markets are, they are constantly searching for efficiency. when we were talking about these things, what are they ultimately leading to? They are ultimately leading to friction, right? They are slowing things down. They are not as efficient as they should be, right? And remember, whenever there is a friction, it always creates opportunity for new solution, right? Companies are actually need for capital to grow and innovate, right? The more money, the more easy it becomes. Investors are recklessly seeking returns. They look for capital constantly which are giving out better yields. Remember that investors are constantly looking for better yields, and businesses are constantly looking for their capital so that they can invest in their business and ultimately grow and innovate. You can perform bank line functions without technically being a bank, right? And that's where shadow banking was born. So, shadow banking is nothing else but a missing middle ground. What happens is, shadow banking isn't really a company, it's basically a very well developed, interconnected ecosystem. And what happens in that? Let's first talk about money market funds. You have probably heard of these, right? They are usually T bills, CDs, which are basically certificate of deposits, then commercial paper, etc. They basically offer investor short term, highly liquid investments. They are basically shadow banking's closest cousin to a saving account. They are safe and they are widely used. Then we have the hedge funds. They basically are a pool of capital that use sophisticated but often aggressive investment strategies, and they operate with enormous flexibility because they are unregulated. Then we have the private credit funds. This is one of the fastest growing areas in finance. These funds lend directly to business, bypassing the banks entirely. Then we have the structured vehicles. They are complex instruments like CDOs, CLOs, and securitization vehicles that bundle and repackage loans. Then we have the repo market. Repo market is nothing but the short term secured lending markets, and this is basically the plumbing of the modern finance. Then we have the finance companies. Finance companies are specialized lenders like maybe auto finance companies or consumer lending companies. They ultimately basically don't really take deposits, but they give out loans. They are all different entities, but they have the same economic function. They move money from the savers to the borrowers just without the traditional banking wrapper. What they are eventually doing is taking money from someone who wants to make an investment. They are taking money from them and giving them to companies who are seeking liquidity or cash, right? So this is what basically bank are doing, right? How shadow banking creates credit. In traditional banks, 100 crore deposit leads to a loan of 80 crore. There is a 20% reserve requirement. But in private credit fund, there is no reserve requirement. Loans issued is 100%. We talked about there is no deposit insurance, and they also don't accept deposits. Why is that? See, when we're talking about a private credit fund, what is happening is capital is being raised. Capital is being raised. So that's why it is not really a deposit but an investment. So there is no insurance. There is risk for which you would be rewarded by return. Right? Now, credit was created without the traditional bank deposit. Right? They raised capital directly from the investor and lent it out. right? Which was basically the core economic function of a bank. But there was no regulatory wrapper or a deposit base. They raised the capital. Let's talk about repo market now. Right? Repo is nothing else but a repurchase agreement. So basically what happens is it is basically a short term secured loan. Right? Let's say a bank or an institution, they hold a bond of 100 rupees. The face value is 100 rupees, but they are in immediate need of a cash. So they might come into an agreement with someone, right? They might sell the bond temporarily, might be for a day, might be for a week, might be for a month, right? But they will sell it for a haircut. That is, they'll sell that for 95 rupees. This 5 rupees is called a haircut, right? This is basically given for the protection for the lender. So after a day, after a week or month, whenever the agreement was, the bank will give you or the institution will give you 100 rupees back. So this 5 rupees different is basically your return to the risk. So this is what repo is. Repo is repurchase agreement. You are coming into an agreement that you will repurchase that particular asset from that particular person in a short term while. Right? So this is what the functioning of repo looks like. This is what haircut looks like. Collateral value was 100 rupees. 95 was cash received by the borrower. 5 rupees was the haircut, and the haircut percentage is 5 rupees, which is ultimately the benefit, the return for the lender. So trillions of dollars move through the repo market every day. This is the plumbing of modern finance. Without the repo markets, many financial institutes would struggle with short-term liquidity. This is basically the hidden engine keeping the system running smoothly. But the thing to be afraid of until it doesn't. So what happens when we have shadow banking? There are more funding options that are available beyond the traditional banking. So you have access to the credit, right? Industries get financed through private credit, infrastructure funds, and specialized vehicles, right? Shadow banking has become a major source of global credit creation. It is affecting GDP, investment, and financial stability worldwide. It is influencing individuals and small businesses who might be rejected from the standard processes of bank, but private credit firms are happy enough to lend these small businesses. They could be happy enough to finance the entire industry as well, right? And the impact is surely seen in global economy. So credit creation doesn't happen only through banks anymore. it is it is it is now dependent on both the traditional banking and the shadow banking together. In traditional banking, the risk is relatively low, hence the return is low as well. With shadow banking, risk is ultimate too high and the return is high as well. So this creates a complete credit ecosystem. So let's talk about some money market funds, right? They're often considered to be something that are extremely safe. But in finance, everything becomes a blunder when the investors panic, right? When the institutions who are dealing in money market like T-bills, CDs, CPs, right? So whenever there is a stress in those markets, investors definitely rush for withdrawal simultaneously, right? The fund may not have enough liquid assets. The problem is liquid assets to meet the demand at once, and this creates a liquidity mismatch. The fund is safe until it's not. That's the dilemma with finance. Liquidity can disappear faster than expected. Liquidity is only as good as the timing is. When the timing becomes bad, liquidity takes the first strike and ultimately leads to a chain reaction of everything failing. Even safe shadow banking instruments can carry risk when confidence evaporates. Right? One of the fastest growing areas in finance today is private credit. Why? Because typically bank interest loans are at 8%, private credit interest are at 12%. Why? Because entire deposit going to loans, there is no insurance at the first place, right? People who are actually taking money from the private credit are coming because they are rejected by maybe the traditional banking systems, right? So the risk is higher as well as the reward. And I told you to remember this particular line: investors are seeking returns and business are seeking funding. When traditional banking fails to offer companies the typical loan, they are often eager to get money from elsewhere. They are willing to pay that 4% difference, right? And investors are always looking for better yield. So that's why private credit is working very good. This provides an extra 4% yields to the investors, right? So high returns, higher risk. There is less regulation, less transparency. The default risk is such big because, see, if you are proficient enough to get a loan from a traditional bank at 8%, everything seems fine. But when traditional banks have not let you enter their system because of something or the other, there might be something that they are that is triggering something, right? So the default risk is higher on these underlying loans. The illiquidity of these funds is higher, right? They're harder to exit, and they could be concentrated in specific sectors or borrowers. So the trade-off is definitely real. More yield come with more risk, right? So now let's just compare what is happening, right? On one side there is more lending and capital access due to shadow banking. But what about regulations? The funding options have definitely increased, but in the system itself there exists leverage, and leverage only favors you when the economy is booming. Whenever there is a hiccup in the economy, it plummets to and starts to bleed you. It encourages financial innovations, but liquidity risk during stress is something that no one can come out of from unless and until we have central banks to support us. They fill gaps left by the regulated banks, but increases the systematic complexity and interconnectedness. It's not whether shadow banking is good or bad, it is whether its risks are fully understood and properly managed or not. Right? There is risk, you need discipline, you need knowledge, and be professional about whatever you are doing so that you can take advantage of any loophole, any friction that is giving you the advantage to make sure that you are given an opportunity. Right? So, shadow banking isn't really a hidden conspiracy, it's just a hidden financial system, and one that has become way too important to ignore. The modern economy does not only runs on bank, it runs ultimately on credit. And credit that comes from places most people never think about. But now you can. So, if you want to understand the hidden systems behind the markets, credit, banking, global finance, and much, much more, I'll definitely suggest you to please subscribe my channel, like, drop in your comments if you have any doubts, and definitely share. Thank you.